Welcome to your Mortgage Insider Update. It is September 22nd. We are just a few days after the Fed announced their first rate cut for 2025. And the typical reaction to the Fed cutting the rates is rates tend to go up, which is an interesting phenomenon. They announced that they were going to cut the rate, the 25 basis points that was highly anticipated. And according to the dot plots, they have scheduled in or pre-scheduled what could be two more rate cuts by the end of the year. But there's some debate over whether that will actually take place. The dot plots are each of the Federal Reserve members' estimate for what the federal funds rate will be into the future. And some of the Fed members, were really aggressive, showing lots of rate cuts expected, and others were not. So the average comes out to be that there would be two more rate cuts because a couple of the Fed members anticipated there was going to be like 50 basis point cuts at each of the next couple of meetings, which would be like 1% lower. Probably not likely because the rest of the Fed members did not agree with that in their estimations. So Fed Chairman Powell didn't help the situation. He kind of stumbled through his press conference and didn't have a lot of great answers for some of the tough questions about the inflation worries, because inflation does still come in around 3%, 2.9% on the core PCE inflation. That's the next inflation report we're going to get is actually the PCE report at the end of this month. Right at the end of the month, we'll also, beginning of October, we'll get jobs numbers. So inflation and jobs really remains at the forefront. So that'll give us another week before there's any major news. We've got PCE coming out next week, and then the following week in October, first Friday, jobs report. So it could be a rocky road. We saw interest rates take a dip. We're going to take a look right now and see what that looks like. So we can see on today the 10-year Treasury up at 4.13. Now, for those of you that can remember from last week, it was at 4.04. So we're up, almost 10 basis points, 9 basis points. We're going to take a look at that on the 10-year Treasury. Mortgage-backed securities are down. That's the opposite of the price. The price will drop as the interest rates are rising. So that's what we're seeing. Let's check out the 10-year Treasury for some context. So going back to September the 5th, where we got the jobs report from last month, we saw the interest rates come down as the jobs report for the month of August came in as light, very light, and some revisions from prior months showing that jobs were not doing very good, and that locked in what was anticipated to be the 25 basis point cut before the Feds actually met. So now that they've met, they've basically met expectations, and in some ways they've kind of left the door open to reverse those expectations. And we're seeing that right after the 17th of September. And just on a note here, you can see that that day, so that when they released the Fed announcement and the initial dot plots without any context, the market actually, we saw the rates dip back down to 4% briefly before they ended the day higher than the day before at 4.07. Then they started the next day off even higher, and that came with some fluctuations. And now we're settling in just above this Fibonacci retracement line, which we're going to take a look at a little further. So back in April of this year, this was the line that we had only crossed below briefly in 10-year interest rates before being held higher, touched it once back on April 30th, and then spent the rest of the year well above this 4.13% Fibonacci retracement level. Now, that's trader speak for the computers are calculating out like what are these lines that are most likely to be either a source of a ceiling or a limiter. For most of this year, it's been limiting that we've been above that number till we broke below it here at the first part of September. Now that we're breaching just above that, not really a good sign. We actually have these little lock alerts that come out periodically, and today we broke above that line. That's something in the industry that we bring to our clients and give them suggestions on when they should lock in. If you're in the middle of a real estate transaction, that's when you can lock in your loan. If you are not in a real estate transaction and you're looking at real estate but haven't bought it yet, you can't really lock in the interest rate. So it's hard to take advantage of these dips. But there are a lot of folks that own their property and have started to look into refinancing because you might have bought your house back early part of this year when rates were higher. So now, this little dip could be the beginning of savings in a refinance of a home loan. But when you're buying a home, that is the challenge is when's the right time? So what we're looking for is a little bit farther down the road here. We'd like to see the PCE number come in a little softer, which is not expected. It's actually expected to be a touch higher in overall inflation, which isn't very helpful. But then the jobs report could be the counterbalance to continue the assumption until October when the Fed meets again and gives us their notes about whether they're going to cut the interest rates another 0.25%. My feeling is that by the end of the year, between October and December, their next two meetings, there could be one more rate cut. There's always a possibility of two, but we'll see. The data will supply the answer. At least that's what Fed Chairman Powell wants us to believe. He's going to be really focused on the data, and all the Fed members will absolutely be paying attention to these reports as they come out. So each week we'll give you a quick update. Feel free to like and share this YouTube page. We'll update this every single week. And then also in our newsletter, you can read through that and get a lot of insights into what happened last week. Have a great one. Bye bye.